Ladies and gentlemen, US markets were down 3% this week, an ugly week, and it had to do with how Trump earnings and data. And today on FinFluential Media, we're going to talk about it all. We're going to talk about recession risks and risks to this market as a whole. The S&P 500 also had a rebalancing. We're going to talk about that and what it means for you guys that hold the S&P 500 and what it means for these additional stocks. Can we take positions in the new additions or the deletions? We'll talk about it. We're going to talk about stock market crashes as a whole. And are we due for one? Very likely. We're going to dive into my portfolio and some key holdings that I have here in the market, as well as my opinions on them. So we're going to talk about all of that good stuff. But before we continue, guys, go ahead, subscribe to FinFluential Media. We are very, very close. We need 1,000 subscribers. That is the goal for the next month, 1,000 subscribers. So hit that like button, guys. Please hit that subscribe button. Subscribe to me. Turn on the notification bell. Now, if you guys hear stuff in the background, noise in the background, there is a legit cyclone going on in Brisbane. High strength category 2, low strength category 3. Now, I live here in the Brisbane area, right here. So this is the Brisbane Metro. I'm about 5 kilometers as the crow flies from the Brisbane Metro. We have this massive cyclone. This is the eye of the storm right here. And then this is the cyclone, pushing these winds through the southeast region from Gold Coast into up here through Brisbane into this Caboolture area. It's pretty destructive. I think things are getting very, very gnarly. I had some boots on the ground, some friends telling me they're seeing peak wind speeds 150 kilometers an hour up in the Gold Coast region. So everybody in Australia, the southeast side of Australia, stay safe out there, stay indoors, and just wait this thing out. It should be a couple of days, and then we should be all good. But let's actually talk about the market. Guys, the S&P 500 down 3% this week. It was a pretty ugly week. We just made lower lows from Monday into Friday. Saw a little bit of a bounce back here on Friday, but a generally ugly week for the S&P 500, and it hasn't been a good year so far. Down 1.89% for the S&P 500. Very solid day today. The NASDAQ 100 as well. 5-day return this week, down 3%, down 5% year to date. The Dow Jones, the only major index that's green this year, but it was actually down so far this week. And the Russell 2000, a little bit of a dumpster fire, down 6% for the year, 4% this week, but up 4.3%. It was a very, very ugly week, and we all know why. It had to do with some of the economic data we got. It's weaker than expected. Market and pricing in a growth slowdown. Also with tariffs, and Trump was really bipolar with these tariffs. He said tariffs on, tariffs off. Even today, he said, we could tariff lumber and 250% tariffs on Canadian dairy. We also had some geopolitical events occur this week. It was all happening. And generally, when you have this uncertainty, when you have this worry, stocks are going to sell off, especially after 2 great years of returns and where valuations are right now. The market's looking for a reason to sell, and that's why we sold this week. Now, under the hood, when you look at the major gauges, things are looking very, very orderly. But when you dive a little bit deeper, things are looking very, very scary for a lot of stocks. Nvidia, that's just the last 5 days, guys. Nvidia was down 8%. Look at Robinhood, down 18%. So we really saw tech growth, hyperscalers, mega cap take it on the chin this week. However, there were a couple of green spots. Number one, consumer staples is up 0.15%. So there's that rotation happening under the hood. Defense stocks, right? This is the global defense stock, ticker DFND, up 10% this week. So defense stocks really making a move. And then we also had value stocks, stuff like Evolution Gaming, a stock I'm invested in, up 2.42% this weekend. This is a great stock because it's a value stock and it's a stock that isn't impacted by tariffs. Tariffs won't really affect this name. And we saw these names do well. And that is why, if you can find stocks that are impervious to tariffs, maybe in the value space as well, that is growing, right? I think they're going to perform very, very well. It's part of the reason why I'm actually in Evolution so far. But guys, the risk of recession has increased significantly. There's a 42% chance of a recession this year. Now, this is the betting markets, obviously, and I don't know how liquid this instrument is, right? It could just be like a couple of people betting on this. So we don't know how valid this is, but the betting markets are pricing in not a 50% chance of a recession, but definitely a high probability of one occurring. And again, that just has to go with all of the policy uncertainty we're seeing, particularly with this administration, federal employees getting laid off, this austerity that often does lead to periods of slower than expected economic growth. And Donald Trump and his administration are trying to thread a needle here as well. We'll see if they can do it, but the market not looking very hopeful and saying, hey, if you keep doing what you're doing, a recession is not likely, but 42% of the way there. Now, we actually had the S&P 500 rebalancing. Now, DoorDash, TKO Group, Williams-Sonoma, and Expand Energy are going to join the S&P 500. In the S&P 100, we had Palantir getting added into that, Intuitive Surgical, as well as ServiceNow. Dow, Kraft Heinz, and Ford Motor getting deleted. Now, in the S&P 500, DoorDash is getting added, TKO Group, Williams-Sonoma, and Expand Energy. And the stocks leaving the index is FMC, Teleflex, Borg Warner, and then Calanese. I don't know how you say that, but these are two material stocks, a healthcare stock and a discretionary stock getting added for comm services. So pretty much we're seeing a lot of these like value names, and we're still seeing growth names being added into the S&P 500. Very interesting. Now, this is going to turn a lot of gears. Hims and Her Health was added to the S&P 400 midcap. This is a very, very big retail name. They've been down a lot. And that was the only notable name getting added to the midcap component of the market. So these are officially effective on March 24th. Now let's actually go ahead, talk about stock market crashes, guys. Now, this month, the month of March, marks the 5th year since the COVID market downturn. This was this downturn right here. It looks like a blip on the radar now. And though the initial downturn on the 9th of March, right, was dramatic, we saw the US markets down 8% in a day. Stocks ultimately recovered literally 4 months later, obviously due to massive stimulus, but it was a crazy time nonetheless. And not even 2 years later, the stock market experienced an even worse drawdown because of inflation. That was this pullback right here, right? And the markets have since recovered. And we are pretty much trading at all-time highs, a little bit off as all-time highs. And if you were invested during the COVID situation, as well as the 2022 drawdown, what were the two major lessons we learned from that? Very, very simple. It's impossible to predict how long the stock market recovery will take. 2022 took about 18 months, 2020 took 4. So it's virtually impossible to predict how long it'll take. But if you don't panic and sell your stocks when the market crashes, you will be rewarded in the long run. And in fact, when we do have these major market pullbacks, right, it's actually the time that you want to be adding to your holdings as a whole. You want to take advantage of those, deploy capital, especially for the super long term. Now, here's a market timeline of pretty much all of the US market crashes going back to 1870. And it's the growth of $1. And through everything here, had you just put $1 since tracking, you would have $31,000 today. Absolutely crazy. Had you put in $100 at that time, you would have $31 million today. You'd be very, very wealthy. So the stock market has completely outperformed inflation. It's one of the best ways to compound your capital in the long term. And these right here is simply opportunities, guys, for you to get long. And I do think stocks are going to do very much the same. I think we are going to see outperformance in equity indices relative to almost every other asset class. And guys, volatility is the price we pay to invest. We do get bear markets every 3.5 years, according to this data right here. We actually get 10% correction every single year. So don't be afraid of market pullbacks, embrace it, and, have capital ready to always deploy. If you do that, you're going to sleep soundly at night. Now, what have I been buying? What does my portfolio look like? Now, this is my latest portfolio. You can see that I'm very concentrated into Visa and Meta, but I do have quite a number of ancillary positions right here. My most recent position is actually APA Group. So this is a utility company in Australia. I bought it just for some defense. I bought it around about last week. Pays a great dividend. Has a little bit of debt on its balance sheet, but it is materially undervalued in my opinion. So I thought it was great to add a little bit of defense to the portfolio. My second newest position is Evolution. If you follow me on Twitter, I've been doing a lot of posts on Evolution, where I think this is absolutely a fantastic business. I also have Pexa Group right here. This is an Australian company. This is truly a monopoly. This company has a 99% market share in Australia. It's expanded globally. That's the type of company you want to be invested in. And then I also have 6% here in PayPal. And then the majority of my money is in Meta and Visa. And these are two positions that have compounded, one of them, Visa, almost over 10 years now. Meta, I bought in 2022, but this is my portfolio, very concentrated, very small. It doesn't include bonds or ETFs that I hold. These are just my single stock equity holdings that I have. So, not a crazy portfolio. I wish I could say more about it, but not an overly big portfolio. I also don't have much time to, manage a portfolio. If you have like 20 positions, how are you getting through 20 earnings calls every single quarter? I just, can become a bit much. So I'm liking that position. I may add a stock or two. I have a lot of stocks on my watch list, but nothing like is a screaming buy to me right now, except for Evolution. I've been buying quite a bit of Evolution at the moment. And I also might go ahead and buy some PayPal. Now, let's actually go ahead and talk about Evolution. Now, year to date, Evolution is up 3%, outperforming the S&P 500, which is down about 2%. So this is the ADR, ticker EVVTY. I'm actually in about here at about $76. So my position is up about 7% in this name. And I absolutely love Evolution. This is a research report that I actually put out on Twitter. And if you guys go ahead and become a channel member to my main channel, FinFluential Television, I'm going to be putting up research reports every single week. We're going to be looking at Evolution. There's going to be one for Nvidia, PayPal, all of my holdings. Now let's go ahead and read. So I recommend I have a buy rating here on this with a price target of $92. Now, despite ongoing competitive pressures, operational speed bumps, and regulatory overhang, we believe Evolution's robust technological infrastructure, proprietary OSS integration, and unique product portfolio create an unmatched brand advantage underpinning its wide economic moat. Evolution stands as the best-in-class supplier in the online gambling industry, offering a compelling investment opportunity for those seeking exposure to this high-growth sector. While risks such as regulatory uncertainty and intensifying competition remain, Evolution's fortress-like balance sheet, negligible debt levels, and operational agility position it to weather these challenges effectively with a proven track record of outsized growth and industry-leading profitability. We view Evolution as a core holding for long-term investors. And when I say industry-leading profitability, look at the revenue to free cash flow conversion. It's almost at 50% here in 2024. Absolutely insane. Now, over the next 5 years, I estimate revenue will grow at a compound annual rate of about 12%, driven by double-digit industry growth and continued international expansion. We forecast free cash flow margins to contract from 60% to 53% due to the two-tier tax hikes and as the revenue mix shifts from unregulated to regulated markets. We view this shift as both essential and accretive for the market to ascribe a higher multiple to the overall business. As a result, my fair value estimate for Evolution is $149, implying a 2029 EV to free cash flow ratio of 15. Our discounted cash flow model uses a 15% weighted average cost of capital. Our next 12-month price target is $92, and we believe this conservative price target is achievable as regulatory risks begin to unwind throughout the year. That stock is already at $80 at the moment, guys. So I initiate a strong buy rating and view shares as materially undervalued. The current 3.2% buyback yield and 3.7% dividend yield pay you to wait as the live casino theme plays out. We also consider the current capital allocation policy as value accretive and believe management should execute as much repurchases as possible given the current discount to fair value. And you can see here that the stock is materially undervalued in the valuation segment. It's got $97 million in total debt. And again, that's on the back of $2.21 billion in revenue. So negligible debt levels, $830 million in cash, great company. And I don't see how this stock doesn't work for many, many years looking ahead, especially at a 12 times PE ratio. Here's what I believe the stock can do over the next 5 years. You're looking at an 18% compounded annual growth rate with a 15 EV to free cash flow multiple. Subtract the net debt, divide by shares outstanding. Shares should decrease by about 1 to 2% every single year for the next 5 years. About 12% revenue growth. And you get an 18% compounded annual growth rate for the name. But that's all for today, guys. If you've made it up until here, guys, please subscribe. It is imperative for you to go ahead and subscribe for small channels to grow. So subscribe. If you like this format, if you want more of these, go ahead, hit that like button and leave something in the comments. And I will catch you guys on the flip side.